Hi, I'm Tom Dalton. This video is the second in a series about partnership formations. What happens when a person contributes services rather than property when forming a partnership? Let's dive right in. As an example of how this works, let's assume there are two people forming a partnership. Partner 1 is a doctor who will provide medical services in exchange for a 50% partnership interest. Partner 2 is contributing land in exchange for a 50% partnership interest. But before we go on, let's look at a question we sidestepped in the first video. What do we mean by a partnership interest? There are actually three types of partnership interests. One is an interest in partnership profits. With a profits interest, a partner will be allocated a percentage of the profits from the business. The second is an interest in losses. With a loss interest, a partner will be allocated a percent of any losses that occur in the business. The third is a capital interest. A capital interest is the amount of partnership property in fair market value that will be distributed to a partner if the partnership dissolves. The partners decide on the profit and loss percentages among themselves. Profit and loss percentages can change whenever the partners agree to change them. But once a partnership is formed, capital interests are determined by the amount of profits and losses allocated to a partner, as well as the partner's distributions from and contributions to the partnership. In our example, Partner 1 agrees to contribute $1,000 of services to the partnership in exchange for a 50% interest. Partner 2 agrees to provide land worth $1,000 to the partnership in return for a 50% interest. Normally, Partner 1 receives cash in exchange for providing medical services. This is similar to wages or independent contractor revenue, and it is all taxable. The only thing that's really different in our example is that Partner 1 is receiving a partnership interest rather than cash for performing the medical services. For Partner 1, the principal is exactly the same as receiving cash. The fair market value of anything received for services is taxable income. Internal Revenue Code Section 721 does not apply to Partner 1's situation. Section 721 only applies when property is exchanged for a partnership interest, not services. Section 83, though, clearly applies. Section 83 says that anytime property is received in an exchange for services, the fair market value of the property is taxable. So, the service partner gets taxed for earning compensation. What happens to the partner who contributes the land? A landmark court case called McDougall v. Commissioner answers that question. When a partner trades services for a capital interest in a partnership, the services partner is purchasing a percentage of the partnership assets. That means that the partners who contribute property are selling a percentage of their property. The McDougall case held that the partners who are contributing property in this situation must, first, recognize the gain or loss on the sale of the property. Second, recognize that they also paid for services. And finally, contribute their remaining property to the partnership in a tax-free transfer under Section 721. How does the math work out? In our example, if the doctor receives a 50% capital interest for her medical services, then the transaction is for half of the land. So first, the doctor buys half of the land, and the other partner has a $300 taxable gain on the sale. Second, the selling partner just spent $500 for medical services, which, if business-related, will be a deductible business expense. The doctor has $500 of taxable compensation, and the other partner has a $500 deductible expense. The doctor's half of the land now has a $500 tax basis. the same as if she took cash compensation of $500 and bought half the land for $500. Partner 2 still owns half the land, and half the tax basis of his land is $200. Third, both partners contribute their half of the land to the partnership in a tax-free Section 721 exchange. The tax basis balance sheet and the fair market value balance sheet summarizes the transaction. The partnership owns the land, and the land has a $700 tax basis, $500 from the doctor's half, and $200 from partner 2. The fair market value of the land, though, remains at $1,000. The doctor's tax basis in her partnership interest is $500, which is equal to her tax basis capital account. Partner 2's tax basis in the partnership interest is $200, the substituted tax basis of his 1/2 interest in the land. Both partners have a 50% economic interest in the partnership, as indicated by their $500 fair market value capital accounts. As we pointed out in the first video, don't confuse tax basis with a partner's fair market value claim on the assets. The fair market value claim on the assets is called the capital interest. In our example, both partners have a $500 claim on the assets of the business immediately after the partnership formation. Up until now in our example, we have assumed that partner 1 received a profits interest, loss interest, and a capital interest when forming the partnership. But is there another alternative? Let's change our example so that partner 1 only receives a profit interest and a loss interest, but no capital interest. Now partner 1 only has a claim on the future profits and losses, but no claim on the current assets of the business. Unless the profit and loss interest can be shown to have a fair market value when partner 1 becomes a partner, then partner 1 has no compensation income. In fact, partner 2 probably doesn't feel it's fair for partner 1 to start off with a capital interest, having not contributed any property. Even though the general rule says there is no compensation income when receiving only a profit and loss interest in a partnership for services, there are some situations where it does become taxable. These are situations where a simple profit interest is shown to actually have a fair market value at the very beginning. An example of this would be if the service partner sells the partnership interest within 2 years after receiving it. Such a short time span indicates that the profit interest might, in fact, have had a fair market value when it was acquired. This is the second in a series of videos about partnership formation. If you have any questions or comments, feel free to send me an email. If you like this video and would like to see more, feel free to hit the subscribe button.